Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting estimated net flows into the conventional fund business, but also including ETFs later on as well for the weekend at August 5th, 2020. Now, what we'll originally do, like I said, we'll report the numbers on the conventional fund business, and then what's left over will be the ETFs, and I'll go into great detail on that as well. It was one of kind of those strange weeks that we had. Basically we saw some really good market performance. The NASDAQ was up. It set its 31st record close for 2020. It's up in the teens. While everybody else is still struggling to get out of the negative returns for the year-to-date return. But the reason we saw this tale of two cities, if you will, is because we saw that the FANG stocks came in and had actually very good earnings reports for second quarter earnings. And I think people just kind of latched onto that and said, hey, the market rally is continuing on. But what put people back on their heels a little bit is, of course, we've had an increase in COVID-19 cases coming out. And we also have had some increased rhetoric and tension between China and the United States as far as trade and political deals go. So really it put people back on their heels and kept people kind of in a pause mode. So while we saw really strong market returns, not a lot of people participated in it. And again, when we saw it, NASDAQ was up 4.32% this week. The Russell 2000 was up 3.04%. We're going to see it was one of the biggest outflows that we had for the week. But anyway, so let's go ahead and take a look at the snapshot and see what this market news actually tallied over and caused for flows into the fund industry. So as I said before, this is XETFs. Equity funds saw net outflows of about $7.2 billion, kind of continuing on with the trends that we've been seeing for quite some time. Taxable bond funds took in a handsome $9.2 billion. Muni bond funds took in about $1.6 billion. And money market funds basically saw about $216 million leave their coffers. So almost nothing to write about there. Well, if we go into a little bit greater detail and take a look at each of the macro groups that I just discussed, I think we'll get a better taste on what was going on. So let's go ahead and turn our attention to the equity fund group and see what was happening there. So basically we saw for the equity funds is that for the sixth consecutive week, they saw plus side performance, 1.48% on average. It's a great return for a 1 week return. And then for the 15th consecutive week, we saw outflows. Again, this has been that trend I was talking about. $3.8 billion left the conventional fund business via equity funds. Now, if we break it down even further, we see domestic equity funds lost about $2.8 billion, 8th consecutive week. They've seen net outflows, and they had a 1.86% return, and they had 6 consecutive weeks of plus side performance. So this is a little bit of head scratcher, right? I think what it is people are just pausing, and they really are hesitant on jumping into this, if you will, near and dear market, right? I mean, everybody thinks it's pretty pricey. Maybe it is properly priced for the FANG stocks and the like, but for the other ones, people are still very concerned. Now we take a look at non-domestic equity funds, and we see that they had about $935 million in outflows. Not a big issue there, but it's the 18th consecutive week that they've seen these outflows, and they had a 0.66% positive return for the 6th consecutive week. So again, we've had a little bit of a strange thing going on as far as positive returns. Obviously, investors are not chasing returns, which is a good sign. But also, we all might be missing out on a little bit of this return. Of course, the fear of missing out could cause us to jump in the wrong time. So it's confusing market time. Large cap funds lost about $1.6 billion on the domestic side. Small cap funds handed back about $992. If we take a look at the international reader of the World Equity Fund Group, international equity funds lost only about $218 million, and global equity funds lost only about $717 million. So again, not a lot of a story behind that. Again, that turns out to be about $1 billion in outflows, but again, we have to kind of put it in perspective what's going on, because some of the returns that we saw, China region funds actually were up quite handsome this week, and actually for the month as well. So again, I think investors are just taking a pause. They're trying to see what's really going to happen in the market. Well, let's go ahead and turn our attention to the ETF side of the arena and see what happened there. And I don't think people will be too surprised to see that, in fact, it was kind of a repeat of what we saw on the open-end side. For the first week in 3, we saw outflows, this time to the tune of $3.4 billion. And the major culprits here, well, we saw that actually Spider Gold took in the largest amount of net new money, $1.7 billion. And I did a research piece this morning and talked about the gold focus. Well, we've seen about 65 maybe $66 billion net new money come into the equity arena via ETFs this year. But we found that over half of that has gone into gold or silver related funds. So really, when we've been talking about net new money coming into equity ETFs, a lot of it has been piling into the safe haven plays. Second group that actually took in money was the iShares Core to MSCI Total International Stock Fund. That index basically took in about $374 million. And on the downside, remember I told you, big winner, Russell 2000, up 3.04% at the top of this conversation that we're having. It had the biggest outflows, about $1.8 billion on the ETF side. SPY, the Spider S&P 500 ETF, lost about $1.4 billion. So really, I think we're telling the same story here. ETF investors, authorized participants, and the consumer, the retail consumer, basically we're kind of on the same trend, and they have been for some time now, where authorized participants are not necessarily putting money to work in the same places that retail investors are, but in these past couple weeks that has actually been the case. Well, let's go ahead now and turn our attention to the fixed income arena to find out what's happening there. And this is a little different story. 7th consecutive week we've seen inflows, this time to the tune of about $8 billion. It's the 6th consecutive week they've had plus side returns, and this time to the tune of 0.55%. Now, we're throwing around 2%, 3%, for the week on the NASDAQ and the Russell. But really, when we're talking about 0.55% for a fixed income fund, that is a very handsome return. Now, the major attractor of assets, investors' assets, was corporate investment grade debt funds. They took in about $5.6 billion this week. And corporate high yield funds took in about $1.6 billion, while balanced funds handed back about $364 million. So again, people have been really, even though the markets have been going crazy, they've actually been kind of in an up mode. Investors are still preferring maybe the safe haven plays, maybe safer assets. Of course, they went into high yield. That's not safe haven. But we are having support by the Fed, and the Fed has basically said they're going to stand behind their claim to keep liquidity in the market. So I think people feeling pretty comfortable with low interest rates. That's a problem, but with low interest rates and no real sign that the Fed is going to start hiking interest rates anytime soon. I think that's what's been happening recently. Let's go ahead and take a look now at our ETF arena and see what's been happening there. So on the ETF side, kind of the same thing we saw on open-end equity side, $1.2 billion in net inflows into the fixed income arena. So we see the retail investor and the authorized participants actually putting money to work in the same areas, this time to a lesser, kind of lesser amount, $1.2 billion. 19th consecutive week, though, they've seen net new money come into that group. And the group at the top, the iShares iBox Dollar High Yield Corporate Bond Fund, the ETF, basically took in about $1.1 billion. Then we saw the Spider Bloomberg Barclays High Yield Bond ETF taking about $748 million. And at the bottom, we're basically seeing the iShares 7 to 10 year Treasury Bond ETF lose about $2.2 billion. So remember I said that people it's kind of a flight to safety? Well, Treasury is almost too safe for people at this time. It's just not paying a lot of money. There's no interest there, so they're going to the spread products, and that's what they're putting money to work. So while they're avoiding kind of the rock and roll on the equity side, they're going to the more rock and roll products on the fixed income side. And so how we basically saw this breakout again is that we saw that the iShares 7 to 10 year Treasury bond lost about $2.2 billion, and the Spider portfolio intermediate term bond trust lose about $1.7 billion. So it's a little bit of a change there. Again, people taking a little bit of a more risk-seeking attitude, getting rid of the treasuries, and I think it's just because they're just not earning a lot of interest and their yields are fairly low. Let's go ahead and now turn our attention back to the flows, and let's go ahead and take a look at muni bond fund flows. Basically, for muni bond funds, we saw inflows for the 13th consecutive week, this time to the tune of $1.4 billion. It's the 15th consecutive week they put up plus side performance. This time they had about a 0.58% return for the week, which was very handsome. The big winners of this group basically were short muni debt funds. They took about $792 million, and general insured muni debt funds took in about $478 million. Now, I don't usually put a slide up, and I'm not going to for the ETF side right now. Muni bond funds is kind of a low trading product in ETFs, but basically they took a pretty handsome $229 million in this week. So the last group we come to is the money market funds. Money market funds, again, for the second week in 3, saw outflows. but this time to the tune of $216 million. Nothing. Taxable money market funds lost about $5 million, and how that broke out is institutional investors actually put in about $480 million. And then we saw the retail investor take out about $480 million, and we really left about $5 million in change. Tax-exempt money market funds, though, if you take a look at that, and I'm going to show you a quick picture of this. The tax-exempt money market funds, if we take a look at that, basically saw about $211 million come into their coffers. So overall, when we're taking a look at it, one of the lowest inflows that we've seen. You can see in the prior weeks at 17 billion out, 20 billion in. And of course, we've been talking about some of the huge flows we've been seeing. But this is that part where I think people are kind of putting on the brakes a little bit, not making any big decisions, not going into, other than gold, going into money markets or out of money markets, or even mass exodus from equity funds. Basically what we're seeing is kind of a holding pattern and the like. Well, that basically does it that's it for me for this round. But basically, we heard this morning that the non-farm payrolls came in for July, up about 1.763 million new jobs, which is it's great to hear. We are slowly but surely getting these and I say non-farm payroll and new jobs. We're basically getting the jobs that were furloughed and laid off back in order. But basically the unemployment rate dropped to 10.2%. We saw in June that was at 11.11%. So slowly but surely we're ticking away. But again, investors, even though we had a good non-farm, I think investors really need to kind of wait and see. We just had a pretty fantastic second quarter earnings season. I told you the FANG stocks came in very good. Our brothers and sisters at the Refinitiv proprietary research team basically showed that of the S&P 500, I don't know what the percentage was, but it's in the upper 400s of the 500 constituents in there. About 83% had beaten analysts' expectations. So again, there's lowered expectations in a huge way, but there was a winning streak there, and I think now we need to take our time. We've had the earnings reports, some comforts there, but we really need to see what's happening with the COVID-19 situation, whether there be any further lockdowns or any restrictions, whether we see if the economy is opening back up. And in particular, I think people are keeping a really good eye on what's happening in the China U.S. relations that have been going on. Well, if I haven't done a deep enough dive for you, you can go to our site at www.lipperusfundflows.com, or you can join us next week when one of our analysts will give you the highlights of the flows for that week. Thanks for joining me. My name is Tom Roseen, and I'm wishing you the best in your wealth planning and creation.